So, what happens when your business has a tough year and ends up in the red? Well, the new Income Tax Act of 2025 has some very specific rules about that. Today, we're going to break down exactly what those rules are, and more importantly, what they mean for your financial strategy moving forward.
Here's what we've got on the agenda. We'll start with the basic problem. Then we'll really dive into Section 112. We'll talk about the 8-year time limit, walk through a real-world example, cover the all-important transition from the old act, and wrap up with the key compliance points you absolutely need to know.
You know, every business goes through cycles. There are good years and, well, not so good years. So what happens when you hit a downturn and your income statement is showing a loss? Let's really frame the problem that this new tax law is designed to address.
So, this is the big question, right? You've posted a loss. What now? How does the tax system actually help you recover? Understanding the relief that's available under the new law, which kicks in from April 1st, 2026, is absolutely essential for any business.
And here's the good news. The new act doesn't just leave you high and dry. It gives you a clear, solid framework for handling this exact situation. And it all revolves around one key provision, Section 112.
Okay, so let's get into the nitty-gritty. What exactly is Section 112, and how does this whole mechanism for carrying forward a business loss actually work?
At its heart, it's a really powerful tool. Think of it as a way for businesses to smooth out their tax bills over several years. The law recognizes that business performance fluctuates, so it lets you offset the profits of a good year with the losses from a bad one. It makes perfect sense.
You know, the process itself is actually very logical. First, you have a loss. If you can't absorb that loss against your other income in that same year, the leftover amount isn't just gone. It gets carried forward to the next tax year, ready to be set off against future business profits.
But, and this is a crucial point to remember, there are limits. This is consistent with the old law, by the way. While Section 112 lets you carry the loss forward, Section 109 tells you what you can use it against. And one thing you cannot use a business loss for is to offset income you've earned from a salary.
Now for something that directly impacts all of your financial planning. There's a deadline. How long do you actually have to use up this loss that you've carried forward?
The new law gives you a window of 8 tax years. That's 8 years immediately following the year the loss happened to carry it forward and use it against future profits.
And for all the seasoned professionals out there, this should be a big relief. This 8-year period, it isn't new. It's exactly the same limit that we had under the old Income Tax Act of 1961. That continuity is so important because it means your existing strategies and financial models don't need to be completely rewritten.
Okay, theory is one thing, but let's make this real. Let's walk through a simple, practical example to see exactly how Section 112 plays out in practice.
Okay, let's look at the numbers. In the tax year 2026-27, the business has a loss of 15 lakhs. That entire amount gets carried forward. The next year, they turn a profit of 10 lakhs. Great! They use 10 lakhs of their carried forward loss to completely wipe out that profit so their taxable income is zero, and they still have 5 lakhs of loss left. The year after, they make 12 lakhs. They use that remaining 5 lakhs of loss and end up paying tax on just 7 lakhs. See, it's a perfect example of the provision at work.
This brings us to what is probably the most critical question for anyone managing existing tax files. What about the losses that came up under the old 1961 tax law? How does the new act handle those?
Well, as you can see here, the fundamental structure for handling business losses is basically the same. Sure, the section numbers have changed. What was Section 72 is now Section 112, but the core rules, the carry-forward period, the set-off principles, they are all consistent. This was done on purpose to make the transition as smooth as possible.
So, what's the legal magic that makes this happen? It's Section 536 of the new Act. This is what's known as a repeal and savings clause. In simple terms, it says that any rights you already had under the old Act, like the right to carry forward a valid loss, are protected and continue under the new law.
Now this brings us to the single most important rule in this whole transition. Your ability to carry a loss forward from the old regime into the new one depends entirely on timely filing under the old Act. Let's say a loss return for assessment year 2024-25 was filed late. Well, that right to carry it forward was lost forever back then. The new Act's saving clause can't magically revive a right that was already forfeited.
So with all of that covered, let's boil it all down. Let's consolidate the key actionable points that you need to remember to stay compliant and really make the most of these rules.
So if you take away one thing today, let it be this. timely filing is everything. Under Section 121 of the new Act, filing your return of loss by the due date is the non-negotiable first step. It's what unlocks your right to carry that loss forward. And remember, the fundamental rules you're already familiar with, that 8-year period and the core set-off principles, they've been kept the same for continuity.
We really hope this explainer has made Section 112 a lot clearer. As you can see, while the section numbers might change, the principles of good financial management and, of course, timely compliance, they never go out of style. If you found this useful, please do like, subscribe, and share.
And just a quick reminder, this video is for educational purposes only and is not professional advice. Tax laws can and do change, so please always consult with your professional advisor before taking any action. Thank you for watching.